Good morning. The Fed raises interest rates 75 basis points another time, as expected, but the market crumbles again. Let's talk about that and some other things on today's Options Brew TV Traders Workshop. I'm lecture host, and we will break it down. Hello, Mark. Good to see you. How are you?
Lex, great to see you. Man, you are getting better every time with these openings.
The cold opening. If Jason were here, he'd be cracking up right now.
The practice is really coming through, though. I can see them improving. Your pacing is getting better. It's great. I love it.
Oh, good. All right, good. We're gonna keep that rolling for now. So, still in the Halloween mode behind me. This Grimley fellow here. He's gonna be leaving probably today. Kind of spooky, but he's from the Halloween, segments. Let's say. What do you think?
Okay, are we getting Christmas decorations coming up next?
We are definitely gonna go Christmassy holiday all the way around the board. So you will see maybe a little Christmas tree back there for the season. What do you think?
I love it.
Yeah, I'm gonna get on the Christmas tree. So you'll be celebrating your holiday in Europe, right?
For Christmas and New Year's, I will actually be back stateside.
Oh, nice.
Doing the rounds to visit the family there.
Well,
so.
we've got to do the rounds and get dinner on the table, so that we have to think about as well.
Yeah, we have 8 weeks.
I know, I love it. Okay, first things first. Let's talk markets. No one was surprised by 75 basis points. We'll just hit this one real quick. Were you? No, it was as expected. I think
highly telegraphed. I think, honestly, in many ways, I think the way the market reacted when it first saw the statement was positively. Like there were some dovish indicators in that statement. But then, man, that presser was brutal. I didn't get a chance to watch it till after the market closed, but some of those comments from Powell were, he does not want to be seen as weak on this. And, I think we're expecting higher terminal rates too. That was another big signal from yesterday from his presser.
Yeah, so I mean, that's what I got to it. I was actually out of the office after the announcement, but everything was hunky dory. The market, the Dow was up 300, 400 points. Next thing I know, total, 800 point reversal, right? And it's obviously the rhetoric afterwards. So I guess the investing public has learned that this isn't stopping anytime soon, right? Is that kind of just the quick statement, bottom line? End of the story. Is that right?
Yeah, I mean, he has opened up, the ability for them to adjust course, come December. He gets 2 more CPI prints between now and then. So I think he just really needs to set the expectation that he's going to bring this inflation numbers down to below where the federal funds rate is. And if inflation's not coming down, the Fed fund rate's going to keep going up. So I think they opened up the idea that they could be, or they recognize the fact that some of these indicators they're looking at are lagging. That was sort of the dovishness in the presser, but Powell, my impression of him is he wants to get this under control to preserve his legacy. He knows he's late to the table here, and he's going to really strong arm this. And he also said, I think another good point was that he said he knows he has the tools to correct if he overcorrects.
Mm-hmm. Okay. I don't know what that means.
That to the extent he overshoots, crushes the economy, he knows he's got the ability to print money again. He knows he can go back to that press. Yeah. And he said so much. So I think he's willing to err on that side. Gotcha.
Well, I mean, I don't know how it all ends. I get the impression that it's one of those things where it's like punching a sticky monkey or something like that. You get your hand stuck and you punch your other one, that one's stuck, and then you kick it and that's stuck, and before you know it, you got a big goo ball on you, right? And you're like, well, what have I done? How do I get out of this mess?
I know exactly the analogy you're making, but I didn't know they had the name the sticky monkey.
Yeah, it's a sticky monkey. You ever have a sticky monkey? You can't get out of the sticky monkey.
Can't get out of this.
No,
that's
man.
Exactly what inflation. That's the Fed's dealing with here.
Yeah. Oh God. Anyhow, all right. So we're gonna keep our eyes on that one for sure. I want to stay.
Everyone's keeping their eyes on him. This guy's the maestro of every risk asset in the world, right? Everything's moving in tune to his,
I gotta tell you, I'm bummed about inflation, and it's noticeable just in my daily trips to the grocery store, I use the grocery store like a refrigerator, meaning I don't keep anything in my refrigerator except for maybe mustard and ketchup and that sort of stuff. But all my produce and stuff, I go to the grocery every day. They have good fresh stuff, and I buy it and cook it that night. And you don't pay attention to the small grocery bills, right? But all of a sudden, the small ones are kind of big ones, even for like nominal things, what I would consider nominal. Like lettuce and bacon and this and that. I'm like, what the heck is on here? I always look at my bill now because the bill's so high. So that's
nuts. And you start going, I can get a cheaper meal if I go out, and then you go out and those are double too. So
yeah, that's unreal. I went out last night to a place, a famous steakhouse. My bill for me alone with tip was like a couple $100. I'm like, what the hell?
Oof. Well, after show, you're gonna have to tell me what you were drinking.
Yeah, I will, but we actually brought a bottle of wine too. So I know that's a corkage, but go figure. Anyhow, yeah, that's me ranting about the problems of inflation. So we are going to keep an eye on this. So we'll chat about this as we learn more information. You brought up a good thing today. I think it's really important for the retail trader to, let's say, understand or at least have a handle on. I'm going to let you tee it up. So it was an article you sent. We won't name the firm in the article, but there's an issue with how retail orders were handled, I think. Why don't you tee it up and tell us what's going on here generally? We'll kind of keep it anonymous who's involved.
Yeah, for sure. I mean, I think it's an interesting story, and maybe it's something that only market structure geeks like me can really appreciate. But I think to your point, like, it's a good thing to know when you're entering orders, what's going on behind the scenes. Because sometimes there are some tricks that you can have in your own execution, knowing the dynamics of kind of what's going on with the other participants there. So I think, generally we're familiar with the idea that when an order comes in from through a brokerage, they're going to go to a wholesaler. So the big options market makers are wholesalers, where they pay the brokerages that payment for order flow for the privilege of executing those orders. And it's a system that sort of benefits both sides, right? The market makers get to trade the orders, the brokerages get compensation for them, and they don't have to worry about the routing and handling them from them. So, there's really good symbiosis there for why this happens. And so when this wholesaler, this market maker was getting the orders, instead of routing them to, and actually, let me step back. When that wholesaler gets an order, generally, for them to trade it on the exchange, they need to open it up to price improvement. And so, the wholesalers, internalizers, when a market maker wants to internalize that order, that customer order, they have to expose it to price competition. Sure. Because they can't just trade it at the best price that they want it to. It's open for other people to respond to the auction, price improve, et cetera. And so that's generally a good thing. I think the vast majority of orders that go into AIM on the SIBO or, PIP or whatever the improvement mechanism, and do get some improvement. So, customers are getting better fills because of, these orders being routed through those mechanisms. Right. To get around sending those orders to that mechanism, trading at cheaper prices, doing less share of the trade, what this firm was doing was they were flash posting the orders on exchanges to signal to their trading arm that this was an order to trade, and then they'd repost it, and boom, they'd be the first one in line to trade it. So
sounds like a no-no.
It's just the way I describe it, right? Like, that sounds like it's
sounds like it's gaming the system, but who am I to say?
It's definitely a gray area. And at the end of the day, I believe it was only a warning that they got from FINRA, that this could be perceived as market manipulation. That type of regulation is incredibly broad, right? Like whether it's the exchanges, the SRO, or FINRA, whoever's investigating you, if they don't like what you're doing, they're going to ask enough questions to stop you from doing it.
Sure. Absolutely. Absolutely. So what was the result of this? Was there some, unswarthiness going on with these orders? I know they didn't get fined or anything, but it was enough to make FINRA interested, which also says to me, okay, don't do this. Right?
Don't do this. Exactly. So I believe the behavior has stopped, and it was actually reported to the regulators by a number of other trading firms.
Okay.
And we would do this. I'm sure you would do this too, right? You see something funky going on in the markets. You want a fair playing field. Someone's doing something illegal, like, especially if it's cutting into your lunch, like, you can take advantage of the regulatory organizations.
Right.
And so I think they provided a bunch of data to like FINRA showing exactly what was going on.
Understood. So what do you think? What's a good piece of advice for a retail trader in terms of placing his or her order in the marketplace? Is there a mechanism that the retail trader can use to mitigate something like this and at least have a chance at price improvement, or not?
Yeah, no, I think so. The main tool that a retail trader has when entering their order is the price that they're going to put on that. And I think it's a major benefit that someone else is dealing with all the routing and fee optimization and, you know, all of that abstracted away. You know, the retail is definitely benefiting from this. Tighter markets, better effective spreads, like absolutely, like sending your order through retail brokerages is a net good thing and has improved for traders. So when you can control that price, there are sort of two games that I like to play, personally, just speaking from experience. You know, looking at the width of the market, I don't always go to take the offer or hit the bid at the beginning. You know, you try and float something out mid-market, and usually what I'll do is I'll float something out mid plus a little bit, because the arrangements that the wholesalers have with the brokerage firms indicates a certain level of price improvement numbers that they want to hit. So you want to find that level for them. And find where the market makers are willing to sell it the most, you know, cheaply and pay the most dearly for that.
Sure.
And so that's an interesting thing. I think number one, float in the middle plus a tick, take advantage of like sort of understanding those bands of price improvement. And then the other counterintuitive trick, and this usually works, you know, if you're working a multiple size or multiple contract order.
Sure.
You know, you only have one contract. It's hard to sort of tease stuff out, but you know, you're working 10 contracts, throw the first contract out, if you're not getting filled at the mid, pay the offer. And if that market's wide enough, that is to say, don't just keep inching up like that, because try for a piece of the order, paying the offer. And sometimes you'll actually get more price improvement that way, because the way the sort of, you know, back end arithmetic and tallying of order types works, that often it's better for a market maker to provide more price improvement on an order that was marketable rather than less on a non-marketable order.
Got it. I got that. Okay. So then what do you do with the balance? You get this one lot as the teaser?
I do the one lot as a teaser. If I see they're giving me improvement, I'll probably go for the other 9 lot.
Oh, you will? Okay.
At the offer.
Okay, got it. And then if they don't, you kind of start sprinkling the infield a little bit with the remaining 9 lot in this example. Yeah,
you can do that. Although often, you know, that's one of the difficulties of slicing your order. That the wholesalers or market makers on the other side see that behavior also. And they say, hey, that was the last traded price. I'm not improving on that. Or, hey, this order, someone was willing to pay up to that price. You know, let's not, you know, carp this one too much. So there's definitely a lot of give and take with sort of slicing your orders.
Got it. Now, what about this idea? So we're creating an order over on our platform, TradeHawk, that will give you the ability to place a starting price. Okay. It could be any price, right? Between the bid and the offer, outside, whatever. And then every time interval that you choose, seconds, minutes, whatever, the bid or offer, depending on what you're doing, will improve itself automatically by an amount that you define as a user. So, for example, let's say I start at $1, and the market's 1 to 150. I can start at $1, which is the bid. I know I won't get filled, and every 5 seconds I move that up a nickel. So after 5 seconds, it goes 105. After another 5, it goes 110, and then 115, etc. And then maybe I pick a spot in the middle somewhere where I stop and I say, now make that a limit order after whatever the time frame elapses, and it's a limit. Or I make it a market order, or I make something happen, right? I think that's a kind of a cool order for a retail person to use, and you can do that with spreads too, right? To try to get some price improvement. But I guess my question to you is, will that behavior be totally understood by the market making side, that they see this kind of uniform improving order out there, or doesn't matter?
I think you hit the nail on the head with that last statement. I think, yes, I think they'll identify it very quickly, but the question is, does it matter? And I think the answer, because at some level, you only get so many ticks between some of these markets, right? That's the beauty of these electronic markets. Top 300 names are all like less than a dime wide. So you start at midpoint. Excuse me. You only get so many ticks before you're just lifting the offer. So, you know, I think it doesn't matter. There's that element to it. And also, someone's going to come in eventually, right? Just because one person's reading that and thinks they're being cute about staying back, that's the beauty of competition, right? At some price, you know, unless they all agree that we see this, at some price, someone's going to trade it. So I think knowing those things, for me, I hear that order type, and I think this would be great for risk I want to take off, not necessarily risk I want to put on.
Okay, makes sense. Yeah, I think it's a cool order. I think where I find to have the most interest in it is around spreads, because we introduce a second and third and fourth leg potentially, and you know, every one of those markets on each leg can be a dime or so, and all of a sudden, you know, the spread looks like it might be wide, maybe not, but people like to get some sort of improvement on their spread trades, is what I see a lot of. So
that's a great call with spreads. No, I actually see a lot of benefit with that as a spread order type. Like you say, because that spread order book could be 20 cents wide in that point. And you know, market makers like spreads because you know, you're reducing your risk, right? You're buying one contract and selling one. You know, assuming you're not sending stupids through there, but like
stupid. I've done that before.
We all have. Like if there's an 8-way call stupid, like sure, no matter how much you tick it up, I think you're gonna have some faded offers. But no, but seriously, like I do think that's a great way for spread orders and the spread books, which are heavily kind of responded to by market makers.
That's funny. Okay, good deal, Mark. Well, listen, you have a great rest of the day and week. Always great talking to you. And we're going to look forward to seeing you back in the States here around the holidays. That'll be awesome. We're going to do a holiday show for sure together in person.
Oh man, we have to figure that out.
Yeah. All right. So we'll do something like that. Good deal.
Very good. And in the meantime, I'm going to go put in an 8-legged put stupid in the SPX.
I like it. That sounds good. All right. I'll talk to you in a little bit.
All right. See you, Lex.
Bye.